Hey there, this is Ike Hoffman with Tactica Real Estate Solutions, and today I want to talk about a trend that I've seen unfolding in the commercial real estate space. As interest rates have continued to rise, I'm hearing more and more about negative leverage. There's a big reason for that. There's now projects coming to the market that have a quoted cap rate that's less than the interest rate on the debt that's going to be used to purchase that given project. While that's definitely less than ideal, that isn't technically the definition of negative leverage. Ironically, negative leverage has been around since I began underwriting deals nearly 10 years ago, and I think some clarifications would be helpful for viewers. So the point of this video, we're going to define what negative leverage is. I'm going to explain why it can be common. We're going to cover how to calculate it and analyze it, and then we're going to look at some real examples and highlight the most common ways to overcome short-term negative leverage. If you've been enjoying Tactica CRE content, I'd really appreciate it if you'd like the video, subscribe to our channel, and allow us to notify you when we're releasing new video content. Let's go ahead and jump in. I think the easiest way to showcase what negative leverage is to use real numbers and dive into a real life scenario. Let's say we're interested in a property that is priced at $10 million and we're going to make a $3 million cash down payment. The projected year one NOI of the property is $725,000. The debt service is going to cost $528,449, and then our cash flow after we pay our debt service would be $196,551. If we take our cash flow after debt service and divide it by our down payment, we get a cash on cash return of 6.55%. Let's also take a look at what our cash on cash return would be if we were to purchase this project in 100% cash. So if our down payment were $10 million, and then our cash flow would just be our NOI of $725,000 because we don't have any debt service, then we would take the cash flow divided by the down payment, and we would get a cash on cash return of 7.25% if we were to pay for this project in cash. Running these two scenarios, we can see that the all cash return of 7.25% is higher than the cash on cash return. It means that the debt is dilutive to our overall returns. From a cash flow perspective, we'd be better off purchasing this deal in cash. This is the definition of negative leverage. The financing is hurting our total yield. The first question you may ask is why an investor would ever move forward on a deal that has projected negative leverage? Well, there's multiple justifications. One big motivator is having less equity in the deal. If you can get a larger loan and bring less cash to the table, that can be incredibly helpful if you're strapped for cash. Another common reason is appreciation expectations. A lot of groups have a business plan that they're banking on appreciation. They're less dependent on cash flow, and they're confident that 2, 3, 5 years down the road, they'll be able to sell the project more than they purchase it for. So there's just less emphasis on cash flow, and having less equity in the deal and achieving appreciation will help bolster IRR and equity multiple metrics, and that may be more important for their business. Probably the most common reason I see is operating upside. Some investors will see negative leverage as a temporary hindrance. However, they're confident over time they're going to be able to increase cash flow by raising rents, improving occupancy, cutting concessions, or expense cutting. And eventually, that negative leverage will flip to being accretive. Another common reason is loan principal paydown. Even though leverage might be hurtful during the investment hold, if you're able to use cash flow and pay off the principal balance of the loan, that will be additional yield that you'll benefit from when you refinance or sell the property one day in the future. And finally, there's just unique preferences. Maybe some buyers aren't as concerned about cash flow or yield at all. They might have a 1031 exchange or other tax motivated ambitions, or maybe they're just an investor that has a huge portfolio of apartments and they want to add units to that and they don't really care about yield. They're willing to overpay and ensure that they're the winning bidder regardless of what their cash on cash return looks like. Earlier in the video, I mentioned that the definition of negative leverage is not that the interest rate of the loan is greater than the cap rate. So what is the definition? The proper definition is when the loan constant is greater than the cap rate. The loan constant is affected by the interest rate, but also the amortization schedule of the loan and if there's any interest-only period. This is best shown in Excel. Let's revisit our previous example where we're looking to purchase a property for $10 million and our LTV was 70%, meaning we would have a $3 million down payment. So our loan amount is going to be $10 million times 70%. The interest rate we'll say is 5.75%. Our amortization is 25 years. And then we'll use a payment formula. We'll take the rate, we'll divide it by 12 because you'll generally make a monthly payment on your real estate mortgage. For the number of periods, we'll take 25, multiply that by 12. Our present value will be 7 million. And then we'll close the bracket. And then we'll take the monthly payment and multiply it by 12, which is an annual debt service payment of $528,449. Now we can calculate our loan constant. Our loan constant is the total annual debt payment divided by the loan amount outstanding. So that's going to equal the $528,000 in principal and interest payments divided by the $7 million. And now let's calculate two different models. So model 2 is going to be the cash on cash, factoring in what our return on our equity is. In other words, we're incorporating the leverage. And then in model 3, we're going to assume that we were to pay 100% in cash and see how that yield looks. So our down payment in a scenario where we have a $10 million purchase price and a $7 million loan, we just take 10 million minus 7 million, 3 million. We'll say that the NOI is 725,000. This is what we're projecting once we take over the property. The debt service payment is going to be the annual payment that we calculated in model 1 in our debt section. And then our cash flow is just going to be 725 minus 528. And then our cash on cash return will be the 196,551 divided by our cash down payment of $3 million, which is 6.55%. Now that we have this scenario entered, I also want to calculate a cap rate. So we're just going to take the NOI divided by the purchase price, and we have a 7.25% cap. When we compare the loan constant to the cap rate, the loan constant is higher. It's 7.55% and the cap rate is 7.25%. So we have negative leverage. Before we run some different scenario analysis, let's go ahead and populate model 3. So in this scenario, we're assuming all cash. So our down payment would be $10 million. And then the cash flow is just the NOI because we wouldn't have any debt service. And then the cash on cash is just cash flow divided by down payment, 7.25%. I'm going to turn these two cells green, the cash on cash return and the cap rate. And then I'm going to apply some conditional formatting. So I'm going to create a new rule. And I'm going to say if this cell, the 6.55% is less than the cash on cash return of 7.25%, we'll turn that cell bright red. So it pops out and is apparent that negative leverage is prevalent. I'll do the same thing with cap rate, but I'm going to compare it to the loan constant. Create a new rule. Conditional formatting equals if 7.25% is less than 7.55%, and then you'll glow red. So what's the easiest way that you can combat negative leverage? The obvious answer is you pay less. You pay less for the deal. Your debt constant isn't going to change. That will stay the same, but your debt service will decrease and the cash on cash has an opportunity to elevate significantly. So if we change this 10 million to 9.5 million, you can see now the cap rate increased to 7.63%, which is greater than the loan constant of 7.55%. And now our cash on cash return is higher than the all cash yield of 7.63%. So just reducing the price by $500,000 made our leverage accretive. We're in positive territory now. Another interesting thing to note is whenever you're in negative leverage territory, adding more leverage will always make your cash on cash return worse. So if we have LTV in the model now and we increase leverage to 75%, the cash on cash return drops to 6.35% when before it was 6.55%. Note, the loan constant didn't change at all. It's just that now debt service is higher with the larger loan, therefore cash flow is less, and the cash on cash return drops even further below the all cash yield of 7.25%. On the flip side, if you use less leverage, so put it back at 70, the cash on cash is 6.55%. Now we go 65% LTV, the cash on cash increases to 6.69%. We're still in negative leverage territory, but the numbers are improved ever so slightly. The other thing you can try to do is negotiate your interest rate. What if you can get this loan, but instead of a 5.75 cap, you can get a 5.25% cap? When we do that, the loan constant drops to 7.19%, which means the cap rate is now higher than the loan constant, and our cash on cash return is higher than the all cash yield, 7.36% versus 7.25%. Another thing that might help is drawing out the amortization schedule. Your payments will be less each month, which will reduce your annual debt service and decrease the loan constant. So we put that at 30 instead of 25. Now the loan constant is 7. The cap rate higher than the loan constant, which means our cash on cash return is going to be higher than our all cash yield, 7.71% versus 7.25%. And if there's no way you can negotiate on purchase price, maybe it's a widely marketed deal where you just have to pay a high bid or the lender's not willing to budge, increasing the NOI also combats negative leverage. So if we take $725,000, increase it to $800,000, now our cap rate bumps up to 8%, which is just $800,000 divided by 10 million, which is higher than the loan constant, which means our cash on cash return is higher than our all cash yield. I've probably seen this a million times in underwriting analysis where the leverage is negative in year one, but the ownership group has a lot of confidence of being able to execute their business plan, increase their NOI. So in future years, maybe in year 2, 3, or 4, that leverage will eventually turn positive once they finish their renovation plan or phase in or execute whatever plans they have in store for the property. The last thing I want to do is show you how this example looks in an actual pro forma underwriting model. So I'm in Tactica's free multifamily template. If you need a tool to help you underwriting your deals, it's linked below. You can download it for free. But I want to use this template to show you what impact an interest-only financing period can have on negative leverage. You can see here in the pricing section, we have a purchase price of $10 million. And then down in the financing section, we have a 70% LTV loan with the same terms that we've been using throughout this video. And once we go to the valuation tab and we focus on the all cash return and the cash on cash return, you can see that the leverage is negative in the first 3 years of the pro forma. Finally, the NOI will increase sufficiently enough in year 4 where that flips. Leverage becomes positive in year 4, and you can see it's color-coded nicely to show you when that switch happens. A common thing I've seen investors do is they'll get a loan that offers an interest-only period. So during the early years of their business plan, they're not going to need to make any principal payments. They will only make interest payments. And in this instance, we're going to plug in a 36-month or 3-year interest-only plan. And now when we jump back to the valuations tab, you can see early in the investment hold, the cash on cash return exceeds significantly that all cash return metric. It's over 10% right off the bat. And that's because in the financing section, no principal payments are being made. There's some risks underwriting a deal this way. And we're seeing that in real time right now. A lot of people had a similar financing arrangement to what I'm showing you now in 2019 and 2020, where they had a few years of interest only, 2 or 3 years, and it's starting to run out now. And when it runs out, you can see that the cash on cash return drops from 11.26% all the way back down to 7.76%. So it's absolutely paramount that you're able to execute a business plan during that time, that you have a less burdensome debt payment, because if you don't, you still could be in that negative leverage territory, or even in worse shape where you're not able to service your fully amortizing debt payment. In summary, negative leverage has been prevalent for a very long time. It catches a lot of headlines today because of those high interest rates, but even back in the low interest rate era, it was honestly very uncommon to find a competitively marketed deal that wasn't exhibiting negative leverage early in the investment hold. And perhaps back then the interest rates weren't playing as big of a factor, but more so it was the cap rates being pushed down. Because interest rates were artificially low, people were maxing out their leverage and getting the largest loans possible and ultimately overpaying, which still created a higher loan constant than where that market cap rate was at the time. So it was honestly quite similar to what we're seeing today, just with different variables doing different things in the negative leverage equation. Forecasting negative leverage early in the investment hold, it can be overcome, but it's important to know that it doesn't entail more risk. It really requires you to either find appreciation when you go to sell the deal one day, and most importantly, being able to execute your business plan, increase that NOI, and turn that leverage positive. To quickly compare whether negative leverage will be prevalent or not, you need to compare the loan constant to your pro forma cap rate. Again, the loan constant is your principal and interest payments divided by the total loan outstanding. The interest rate, amortization schedules, loan amounts, and interest-only periods will all factor into that loan constant formula. That wraps up the video. If you've been enjoying Tactica CRE content, I'd really appreciate it if you'd like the video, subscribe to our channel, and allow us to notify you when we're releasing new video content. Thanks for tuning in.